Okay, Bismillahirrahmanirrahim. Um, yeah, let's continue with our lesson. Okay, next part is the estimation of cash flow. Okay, this is where the hardcore calculation part of this chapter begin. Okay, so before we begin, let me explain to you the structure of this thing. Okay, so firstly, right now you need to know that we only do this calculation, the estimation of cash flow, um when we are considering a project. Okay, when we are considering either to purchase an asset, a new asset, or we want to keep using the old asset. Okay, so basically there are few components. Okay, number one is the initial investment. Okay, this is the first component of cash flow estimation. Number two is the operating cash flow, also otherwise known as annual cash flow. Number three is the terminal cash flow. And lastly, the analysis is called NPV analysis, net present value analysis. Okay, and then we also do payback period calculation. Sometimes we also do discounted payback period. Okay, for discounted payback period is not in the module. Okay, but it is asked in the exercises section in the module. So you need to uh, be able to solve it in case it come up in final exam. Okay. So for the initial investment, okay, firstly, note, please understand that we do this calculation, we do this analysis before we start taking any projects. Okay, meaning to say, okay, this all these thing happens, okay, especially initial investment, it happens in year zero. Okay, in year zero, operating cash flow is basically a projected. Okay, it's not actual cash flow, it's projected. We just make a projection. It will start from year one until year end. Okay, last the final years of the project. Let's say we estimate the project is going to run for 5 years, then the end of the period will be year five. Okay, terminal cash flow will be um assessed on the year end. Okay, the final period. Okay, and then the everything, okay, will be included in the NPV analysis. Okay, next, another thing that you need to know is when we talk about initial investment, okay, we are talking about, there are two components here. Okay, number one is the cost of assets, and number two, we have working capital requirement. Okay, so we have this. Okay, we have to calculate this. Okay, we have to consider this. Now, let's look at the notes. Okay, so initial investment is basically the upfront cash or cash flow to start the project. Basically, year zero. Okay, we start the project in year one. So when we talk about initial investment, it is the cash that we consider to start in year zero. Okay, so example here, as mentioned, okay, we have the cost of asset in this example, machine, and then we have working capital management. Okay, for the working capital management, okay, we have inventory, okay, 7,500 ringgit, and then we have 2,500 ringgit to finance the inventory using not account receivable. This is a typo, account payable. Okay, the idea is that, okay, uh, the money that we spend, which is purchase of inventory, okay, basically assets, sorry, the purchase of inventory, let's call it the purchase of inventory. Okay, um when we spend money, okay, it represent cash outflow, right? So that's why all this in negative format, okay, in bracket, this represents cash outflow. Okay, and this 7,500 ringgit, okay, otherwise would be all as cash outflow, but part of it, 2,500 ringgit, is financed through in account payable, meaning to say we owe money. Okay, so the actual amount that we spend is 5,000 ringgit. Okay, the whole value is 7,500 ringgit, but we only paid 5,000 ringgit. Okay, so here at this point in year zero, we have cash outflow. Why? Because we spent 23,500 ringgit to pay for the machine, okay, the cost of the machine, and then the working capital requirement. So total initial investment is 28,500 ringgit. Now, this is very important. Okay, later on, we have to calculate depreciation cost. Okay, for depreciation cost, we will only consider the cost of assets. Okay, the cost of machines. Okay, 23,500 ringgit. We do not take the whole thing. Okay, please remember this because there were many students in the past that when they calculate the depreciation, okay, they would take the total initial investment. If you do this, you won't get any marks at all. Okay, straight away, zero. Okay, so please do not do this mistake. Okay, only take the cost of machines. And when we talk about the cost of machines, okay, it's not just the cost of the asset. Cost of the assets includes cost of is include the actual cost. If there is any installation cost, it will include it as well. Basically, it includes whatever costs associated with bringing the assets into a working condition. Okay, for example, transportation costs. Okay, let's say we purchase the cost, we import we import the assets from abroad. Okay, import duty, for example. Okay, once it arrive here in Malaysia, let's say in Port Klang, okay, we want to transport the item from the port to our compound, business compound, okay, we have to pay transportation cost. Then that transportation cost we also included in the cost of assets. Next, tuning up, okay, for example, apart from installation, let's say of the asset, maybe we have to up some software to make the assets to actually be working. Okay, so all these costs actually needs to be included in the cost of asset. If let's say we have to pay for a special engineer, okay, to install, okay, then we are going to actually include the costs into the overall cost of assets as well. Okay, so wait, yeah, I need to make sure that maybe I can just leave the training first. Okay, all right. So this is the calculation for the cost of asset. Okay, remember. Okay, if we provide you with all this other information in exams, you have to take this into consideration. Okay, you cannot simply take the cost of asset alone as the cost of assets. Okay, so this is the initial investment. Remember, for depreciation, only take the cost of assets, exclude working capital requirement. Okay, next. Okay, depending on the question, sometimes, okay, let me move this first. Okay, now, sometimes, most of the time, we would expect full recovery of working capital requirement. Full recovery. What does it mean? It means that, okay, here, we purchase inventory worth 7,500 ringgit, right? Okay, so money goes out, right? 7,500 ringgit. Now, at the end of the period, year five, for example, do we plan to sell this inventory? Yes, definitely. There is no point. If we want to close our business, we want to keep this inventory, unsold inventory. We definitely want to sell this. And for the sake of this process, this cash flow analysis, we would expect that we will recover everything. So in year one, if we spend 7,500 ringgit for the inventory, in the terminal cash flow, year end, we would recover all 7,500 ringgit. And if here in the initial investment period, we take loans, 2,500 ringgit, okay, from our account payable to pay for our inventory. Okay, we purchase on credit, 2,500 ringgit. At the end of the period, we would expect to pay this. Okay, we cannot simply go out of business, okay, and not paying the account payable. So we have to pay this. So this 2,500 ringgit will represent cash outflow at the end of the period. So if I want to put this here, okay, in year zero, let me insert, okay, year zero. Okay, let's say let's do 3 years only. Okay, year two, year three. Okay, in year zero, firstly, um, we will spend 7,500 ringgit. This is to pay for inventory, right? And then out of this 7,500 ringgit, 2,500 ringgit was a credit purchase. Okay. So the net amount, okay, the net amount would be 5,000 ringgit outflow, exactly like in our module. And in terminal cash flow, okay, in year three, we would expect number one to sell all of our inventory. So this will represent cash inflow. Okay, we get the cash. Okay, 7,500 ringgit. Wait, let me. Okay, and then we also will be expected to pay our account payable. So paying account payable, this resulted into cash outflow minus 2,500 ringgit. So a total of now cash inflow of 5,000 ringgit. So this is the relation between initial investment and terminal cash flow. Okay. So this is the first relationship. Okay. The second relationship, we are only talking about working capital requirement now. Okay. Only the working capital requirement. Next, on the cost of assets. Okay. Let's say the purchase of cost of assets here is 23,500 ringgit. Okay. So minus 23,500, right? Okay. Here, at the end of the period, at the end of the project period, okay, we are not going to keep that asset with us. Okay. So in this case, we will recover this amount, a certain amount. Okay. In the question, we would specify it. Okay. For example, there is a scrap value of 5,000 ringgit, and if we sell at 5,000, we will recover exactly 5,000 ringgit, for example. Okay, we will discuss this again in detail later. Okay, because there is a whole lot of other calculation here. Okay, yeah, I really wish, we could do this face to face. Hmm. Never mind. Let's do the recording first. Okay. Maybe later on we will discuss if we're going to repeat this again in class. All right. So that is the initial investment and the relationship to terminal cash flow. Basically, whatever that we record in the initial investment, please note that we also expect to occur in terminal cash flow. Okay. So please remember this. Okay. Next, let's move on to the next part, which is projection of cash flow. Okay, for the projection of cash flow, okay, we will project, when we talk about cash flow, yeah, okay, we are talking about the cash inflow and the cash outflow, right? So when we talk about cash inflow, obviously, here we are talking about the revenue. Okay, in most cases, in most questions, we would provide you with the sales quantity and then the sales price. Okay, so what you need to do is sales quantity times sales price. So you will get total sales revenue. Okay, we expect you to do this. Okay, next for the for the outflow, here we are talking about all the expenses. Now we do this in a very structured manner. Okay, we structure it in the form of variable cost. For variable cost, usually we are talking about the materials to our product. Okay, usually we would give you the quantity. Okay, the quantity of the material used, or sometimes you have to calculate it yourself. Okay, and also the cost per unit. So you have to find out the total variable cost. Next, we have our fixed cost. Okay, for the fixed cost, this includes all other expenses. Okay, for example, salary, then rental, depreciation, definitely. But depreciation will be calculated. Sorry, it's not will be calculated. It will be added up later. Okay, I will explain it later. Okay, depreciation, and then what else? Usually it could include admin costs as well. Okay, whatever fixed costs. Okay, you have to classify the cost into variable cost and fixed cost in a very structured manner. Okay, and then okay, this one you can read on your own. Okay, so this basically is the calculation earlier. Okay. Hmm. In this example, please note that WACC is calculated with a new figure. Okay, we do not use the WACC and the CAPM, the cost of equity from the previous example. Okay, this is totally a new example. Okay, so this is basically the assumption. Okay, the key financial assumption for the business. Okay, for this example. Okay. So as you can see here, the projections are 20 cups of coffee per day at ringgit and 50 cent, while tea is 10 cups per day at 5 ringgit. So what you need to do is you just calculate it. Okay. There's also assumption of the operation to only operate 5 days per week. Okay, for 52 weeks. 52 weeks means 1 year lah. Okay. So a total of 260 days operation. Okay, with this much sales. Okay. Is it 25 cups? Sebab kat atas ni 20 cups, kan? So, I think this is a typo. Should be 25, hopefully. Okay. So, and 15 cups for tea. Yang ni pun typo. Okay, later please correct this. 25 cups and 10 cups. Okay. So, we just calculate it. Okay. For the sales, for example, 25 times 260 days. Okay. And times the price per unit. Okay, so this is the amount. And then for the tea, okay, 3,900 cups, okay, times 5 ringgit. So we get a total sales for the first year. Okay, so this working, okay, you need to perform this working separately. Okay, you can actually do it simultaneously while you are preparing this summary. This is the year, the end product that we would expect from you. Okay, you can calculate it here or here. Okay, but to make sure that you do not confuse yourself, we advise you to separate the calculation, right? Okay, so as you can see here, this is the sales revenue calculated from above. Okay, this one. And for the variable cost, okay, we just calculate the cost of the material here. Okay, because in this example, there is no other variable cost. Okay, but you have to be very careful. If certain questions, okay, is designed to be more difficult, okay, sometimes we could include different kind of variable costs. Okay, so you have to be very alert with this. Okay, so that's the total variable cost, and the assumption is that total sales revenue increased by 30%, while total cost increased by 4%. Okay, I will address this later in class in our discussion because I don't want to make this session to be too complicated. Okay, I will address this in our next class when we do exercises together. Okay, next, please note that. Okay, the fixed cost 24,000 ringgit. How do we get the 24,000 ringgit? Okay, you see here fixed cost 1,800 ringgit per month. This is for extra worker and 200 per month. Not sure what's the fixed cost here. Okay, it's not stated. Okay, so the total is 2,000 ringgit per month. Okay, so per year we have 12 months. So if you times this by 12, that's why we've got 24,000 here as the fixed cost. Okay, for the fixed cost in exam, make sure you read it carefully. Okay, you just record it adequately. Okay, so please do not miss any portion of the question. Okay, let's calculate the depreciation. How to calculate the depreciation? Okay, look, go back to our um, initial investment. You see here, the machine is 23,500 ringgit. Okay, and equipment will be depreciated over 3 years. Okay, so 23,500 ringgit divided by 3. So, okay, maybe there is a salvage value. Where is the salvage value? Okay, 23,500 ringgit. Where is it? Is there any information here? I thought somehow tak ada. Okay. I think, wait Ni kita tengok jap. Slowly. Ah, oh my God. Bukan. Dia mention. Dia tak ada mention kat sini. Okay, dia tak ada mention. Okay, but we can, I can work backwards here. Okay, let's work backwards, because I think it's missing somewhere. Okay, so here 16,500 ringgit times 3. Is it 3 years? Yeah, 3 years. Okay, and the original cost is 22,500 ringgit, right? Okay, so the salvage value is 4,000. Okay, I think this is missing from the question. Okay, why? Because the calculation of um depreciation in this case would be minus 19,500 ringgit divide by 3. Okay. Sorry, not minus 19,500 ringgit. Minus 4,000, minus salvage value. Okay, this is the formula of depreciation. Okay, you will learn this in accounting. Okay, so a total of 6,500 ringgit per year. Okay, so sales revenue minus variable cost minus fixed cost minus depreciation will get operating income. Okay, we take this and times our tax rate, we get our tax that we need to pay. Okay, and then operating income minus tax will get our cash flow and add back to our depreciation. Why add back? Because this is cash flow analysis. We only consider the cash-based expenses and revenue. Okay, if it's not cash in nature, we don't include it here. So depreciation is not cash in nature. So that's why we add back the depreciation. But in case you're wondering, so if it's not cash, why do we have to include in the calculation of cost? Because although depreciation is not cash, it is still a type of expenses. So when we talk about a type of expenses, it will be included in the calculation of tax. Okay, so to calculate the tax, we have to include the depreciation. But after we get our tax, we have to add back our depreciation. Okay, because it's not cash. So what do we get here is net cash flow. So you repeat everything the same for 3 years period, you will get a stream of cash flow. This is what we call as operating cash flow. We operate for 3 years, and this is the cash flow generated from our operation. Okay, so this is operating cash flow. So the last one is investment decision. Should we invest knowing this is what we could generate from our project? Okay, it's not a simple yes or no. Okay, because before we make the decision, we have to make another analysis that is called, where is it? NPV. Okay, this is the analysis that we're going to do here. NPV analysis. Okay, for the NPV analysis, what we need to do is we just include all the cash flows. Okay, let me put it here to show this to you. Okay, in year zero, taking this from the question, yeah. Okay, let me put it properly. Year inflow, outflow, year zero, year one, year two, year three. Okay, and then let's do year three. This is for terminal cash flow. Okay, terminal cash flow. Okay, let's separate this, okay, to show you clearly. Okay, so this is operating cash flow. All these three are operating cash flow. Okay, and this is the initial cash flow. All right, now for the initial cash flow, okay, let's take from our example, 28,500 ringgit. 28,500 ringgit negative, must be negative. Okay, sorry, this should be, let's put this together. Senang cash flow. Okay, must be negative. Okay, sorry. Okay, for operating cash flow, we just take directly from our projection of cash flow or cash flow analysis. Okay, year one, 17,406, 17,406. Year two, 30,241.06. 0.64, sorry, 0.64. Okay, I think we need to show the decimals. Okay, next. Year three is 47251.25. 47251.25. Okay, and this is the terminal cash flow. Okay, for the terminal cash flow, I'm not sure if it's here. It's not here. Okay, as you can see here, this is CF0, CF1, 2, and 3. Okay, I'm going to show you the calculation. Okay, let's say, okay, in this situation, we consider the scrap value, okay, as 4,000 ringgit. And let's consider the what does it mean, scrap value? Scrap value means the value of the machine at the end of the period of usage, at the end of useful life. We use this machine for 3 years, okay, and after 3 years, how much does it worth? 4,000 ringgit. Now, let's assume we can sell this machine at 4,000 ringgit. So, let's include 4,000 ringgit here. Okay, now the total, sorry, okay, the total is 7399. Okay, yeah, okay, this amount. Okay, now, should we so what does it means actually? Okay, this is what we do if you want to answer. Should we consider to do this project or not? Okay, the cost that we spend is 28,500 ringgit, and this is the total amount that we generate. If you can see here, the amount is 98,000 ringgit. Okay, now a simple mathematics would tell us that yes, we should continue with this project because we earn more than what we spend. But please be careful because we want to do the decision today, year zero, but this income is in the future. Okay, so we need to do some discounting here. Okay, this is the future value. This is the present value. So what we need to do is just apply the formula, the TVM formula, future value. This is the future value over what's the interest rate here? We get the interest rate from our WACC here. So in this case, 4.45%. So 1.0445. This is 4.45% to the power of the compounding period. So this is to the power of 1 lah. Okay. So this is the present value. Okay. So this is the present value. Let me, okay. So this is the PV, present value. Okay. And we apply to all calculations. Okay. This one as well. Okay. Sorry. Okay, this one. Right. So next, what we do is we just sum everything. Okay. This is the NPV. Okay, why NPV? NPV means the present value of cash out inflow minus the present value of cash outflow. We are finding the net amount. Okay, so as long as the NPV is greater than zero, NPV is greater than zero, accept the project. This is the basis of our um, decision. Okay, NPV is greater than zero, accept the project. Okay, so in this case, obviously the NPV is 60,000 is greater than zero. If we go back to our textbook example, the NPV is 66,300. This one, this is sorry, this is excess cash flow. Where's the NPV? This one. This is the NPV. Okay, I need NPV there. Okay, 57,000. Okay, why the amount is different than mine is because I include the terminal cash flow. If we delete this, okay, it's just the same thing. Okay, 57,349.73. Okay, tapi yang kat sini I tambah kan, I tambah 4,000 tadi, terminal cash flow. Right? So that is the NPV. Okay, MPV is considered as the primary technique in capital budgeting, okay, because it takes into consideration the time value of money, okay, it takes into consideration how much we could generate from the project and it factor in the time value of money, okay, so that's why it's used. It's almost like we consider it among the most accurate techniques, analysis techniques, okay, but also in this module, we also have the payback period, okay, so what is payback period? Okay, I'm going to show you here. Okay, year zero. And then we have year one, year two, year three, right? Okay. Um, cash flow. Okay, for the cash flow, year zero, we spend 28,500 ringgit for the initial cash flow. Okay, year one, we get this much from our operating cash flow. Year two pun ada juga. And then year three, let's add this together with our terminal cash flow. Okay, tapi tak apa because in this example, in the module we don't have terminal cash flow kan. Okay, so we exclude terminal cash flow. Okay, let's use the same example. Otherwise later you will be pening later. Okay, so the payback period. The payback period is basically we want to know. In Malay we call it as pulang modal lah. How long can we recover all this amount? So in year zero, Okay, we spent 28,500 ringgit. So this is basically the balance, sorry, the balance. So in year zero, we just spent, we haven't earned anything. So the balance obviously is 28,500 ringgit. Right. In year one, we earn some money. Okay, this is the amount that we want to recover. This is the money that we earn. So how much is the balance? Okay, we take this and we add this. Okay, so there is a balance of 11,094 ringgit. Okay, and so in this case here, have we recover? Have we recover? Okay, here in year zero, obviously no lah. Okay, no. Okay, how about year one? We haven't recovered yet. Everything, no. Okay, and in year two, as you can see, we need to recover 11,000, but we make a profit of 30,000. So do you think we have recovered now? Yes, right. We have recovered, but we need to get the actual period. Okay? Because in exam, we expect you to tell us when to be recovering. So how do we calculate it? We take this amount, 11,904. This is the amount that we need to recover. We divide by 30,241.64. Okay? The logic is that, okay, if you draw a timeline, okay, over the years you earn this much, but you want to know when exactly you hit this amount. So this is the formula. Okay, so here the answer would be um 0.39. Okay, 0.39. So we need one, okay, plus 1 year. So because here we still have the 1 year period. Okay, so that would be 1.3, sorry, plus this one. Okay, this is the period. Okay, 1.394. Let me record kat situ je lah. Okay, 1.39 je lah. Ya. Yeah. Okay, 1.37 somehow amount dia tak sama. Kenapa tak sama eh? Hmm. Yeah, I calculate it correctly. 11,094 divide by ni kan. I don't know, maybe there's some calculation error. Okay. Okay, you take the 11,094 over this. Okay. I form the same calculation somehow. Kenapa tak sama eh? Maybe it's, I'm not sure. Okay, I'm not sure. Kan, sama kan? 241, 241. Ya, sama. Okay, tak sure kenapa. Okay, so that's it. That's the payback period. Whereas for discounted payback period, instead of using this, we're going to use the discounted figure, this one. Okay, so for discounted figure, we take this amount. Okay, dia jadi macam ni. Okay, so nanti dia jadi 11,836. Okay, so oh my god, lebih kurang, 1.39. Okay, 1.39. Tapi dia ada beza sikit lah. Macam tadi dia punya decimals dia 394 if I'm not mistaken, right? Ni 390. Okay, dia ada pendek sikit. Okay, so that is the content on chapter 8. Okay, please watch the calculation, sorry, the recording, because in our next class, we will discuss all these questions in the class. Okay? Okay, that's all. Hopefully, um, there is no problem with the recording. I'm worried there is a problem with the recording. Okay, so hopefully you can watch it. I'm not sure how long is the recording, because for me here I've got like 2 hours. It's not, it shouldn't be full 2 hours, because I stopped the recording earlier for my workshop and then I continue recording later. So that's it. Okay. See you in class. All right. So let's stop our recording.